All right, welcome. Today we're diving into a really hot topic, Singapore's data centers. This sector is seeing just a massive flood of investment. But the big question is it a guaranteed win? A digital gold rush? Or are there some serious risks that investors might be overlooking? We're going to unpack both sides of this pretty high-stakes debate. First things first, let's get on the same page about what we're even talking about. When you hear data center, I don't want you to think of some abstract cloud floating up in the sky. No, think of these massive, highly specialized physical buildings. I mean, these are the real engine rooms of our entire digital world. From an investor's point of view, this is mission-critical real estate. It's not just a tech play. So what is a data center at its core? Well, it's a facility that makes money by selling something really simple, reliability. And that reliability is built on these four pillars you see here: power, cooling, connectivity, and resilience. Customers aren't just renting a box. They're buying a rock-solid guarantee that their digital operations will never go down. And that right there makes this a much, much more complex asset than your average office building. Okay, so here's our game plan. First, we'll look at the digital gold rush, this massive wave of demand that's driving the market. Then, we'll unpack why Singapore is in such a premium spot. From there, we'll jump right into the main event, the bull case, which is all about scarcity versus the realist rebuttal. And finally, we'll get practical and look at how you can actually invest, leaving you with a clear framework to think about it all. So let's set the scene. For years now, the need for computing power has just been exploding, right? Mostly thanks to everything moving to the cloud. But now, there's a whole new tidal wave building on the horizon, and its name is artificial intelligence. And what's really wild here is just the sheer scale of this shift. You can see it on the chart. Your traditional workloads, they're growing at a nice, steady 7% a year. But then, look all the way to the right. Generative AI. That's projected to grow at a staggering 65% annually. This isn't just a little bump. It's a full-blown explosion in demand for data center capacity. Okay, so with all that demand sloshing around, why is Singapore so special? Why does it get to charge a premium? Before we get into the whole bull versus bear debate, we really need to understand the fundamentals that make Singapore a top-tier market for this stuff. Singapore's advantages are just baked right in. It's a global hub for those giant undersea internet cables. It's got this incredibly dense digital ecosystem of cloud providers and big banks. And maybe most importantly, it offers institutional trust. The rules are clear, they're enforced, and everyone knows it. You can't just copy these things overnight, which makes Singapore a premium node in the global digital network. And this brings us to the most important point of all. Singapore has deliberately put limits on land and power. And you might think that's a weakness for investors, but it's not. It's the very heart of the investment case. The fact that new supply is so tightly controlled is exactly what makes the existing data centers and the few new ones that get approved so incredibly valuable. Scarcity here is a feature, not a bug. So let's lean into that and build out the bull case. The argument is actually pretty simple, but it's really powerful. You've got this supercharged demand from AI smashing up against a severely limited supply. That, my friends, is a pretty compelling recipe for an investment. And this number right here, 500 megawatts, is basically the entire story on the supply side. That's the total new capacity the government is planning to add. This isn't a free-for-all where anyone with cash can build. Nope, it's a highly controlled allocation. Only the absolute best, most efficient, and greenest projects are going to get the nod, which keeps supply tight and prices strong for everyone already in the game. This quote from the source material just sums up the bull case perfectly. The constraints don't make the market weaker, they sharpen it. They act like a magnifying glass, amplifying the value of every single megawatt of capacity that's already approved, hooked up to the grid, and built to modern standards. Okay, that all sounds pretty great, but hold on, it's not quite that simple. Now we have to bring in the realist's rebuttal. This view argues that, yeah, the demand story is amazing, but investors are really underestimating the huge operational and execution risks that come with actually building this stuff. And this is the key question the realist puts on the table. It completely shifts the focus from the exciting demand story to the messy, real-world challenges of getting these things built and running. So what could actually go wrong? And here's that checklist of bottlenecks. Power isn't just scarce, it is the absolute #1 roadblock. And those new AI chips, they run so hot you can't just blow cold air on them anymore. We're talking about complex, expensive liquid cooling systems. Plus, construction costs are going up. And here's the kicker. Money is getting smarter. Capital is becoming way more selective, and it's steering clear of projects that haven't already locked down their land, power, and permits. The bottom line is, not every planned megawatt is actually going to get built, or be profitable if it does. The realist also points to what's happening just across the border. See, Singapore's constraints are pushing the huge hyperscale developments into Johor, in Malaysia. Singapore stays as the premium hub, the place for high-value, super-sensitive data. But Johor is becoming the scale valve, basically absorbing the massive overflow of demand. Investors have to see this as a two-tiered market, not just one. So you've heard the bull argument and the realist's counterpoint. So how can an investor actually get a piece of the action? Well, let's break it down into 3 practical buckets of investment types you can look at. Okay, so here are the 3 main ways to play this. First, you've got the direct owners. These are the pure plays, like Keppel DC REIT, that do nothing but own and operate data centers. Second, the partial landlords. Think of big property companies like Mapletree Industrial Trust that have a big chunk of their portfolio in data centers. And third, you have the indirect enablers. These are the companies that supply all the critical guts. The power systems, the cooling pipes. Each one gives you a totally different flavor of exposure, with different risks and rewards. And if you're really going to dig into one of those pure play owners, here's a quick framework. 1, you have to scrutinize the leases. Who are the tenants and how long are they locked in for? That's what WELL, or weighted average lease expiry, tells you. 2, and this is crucial, are power costs passed through to the tenants? 3, check the balance sheet for any nasty surprises with debt. And 4, what's the growth pipeline look like from their parent company? Okay, let's pull all of this together now into one final framework. How should you, as an investor, keep an eye on this complex, fast-moving sector so you can make some smart decisions? I want you to think about it like a hierarchy, or like peeling an onion, from the top down. You start with the big picture sector signals, things like government policy on power or overall vacancy rates. That sets the whole stage. Then you drill down to the direct owners and look for signals on leasing and funding. After that, check the partial landlords to see if their development plans are actually turning into real buildings. And finally, you look to the indirect enablers for confirmation. Are they winning contracts? What do their profit margins look like? If you follow this sequence, you won't overreact to a single headline. So at the end of the day, there isn't really a winner in the bull versus realist debate. The real key takeaway here is to be disciplined. As an investor, your job is to separate these different business models. You have to understand that owning the building is not the same as selling the pipes for it. You have to distinguish between that stable, recurring rent check and lumpy one-off project revenue. And you absolutely have to understand the difference between the premium economics of Singapore and the overflow growth happening right next door. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.